Ora, boa tarde a todos. O meu nome é Ricardo Contins, sou gestor de produto no BiG. Sejam todos bem-vindos a mais um webinar em parceria com o CME Group, mais uma série da Chicago Trading Sessions. Iremos, dentro de alguns minutos, iniciar esta nova visita ao Chicago Trading Sessions, desta vez com 4 sessões. Eu iria pedir-vos para darmos aqui apenas alguns instantes para que todos os elementos possam aqui juntar a nós e aproveitava para questionar, ainda antes de começarmos, se conseguem ver o ecrã, se me conseguem ouvir, como fazemos em webinars anteriores. Eu agradeço então aqui a confirmação. Perfeito. Relembro que este webinar irá ser maioritariamente conduzido em inglês. Vamos ter aqui o economista sénior do CME Group, Eric Norland. Ele vai dar aqui esta mesma apresentação que devem estar a ver no vosso ecrã e possivelmente depois vamos ter aqui várias possibilidades de interagir e até para quem não se sentir totalmente à vontade poderão interagir pela linha de chat em português. Terei todo o gosto em mediar e ajudar aqui no que seja necessário. Por agora, vou pedir-vos então que nos deem apenas alguns instantes para que todos os elementos possam aqui juntar e daremos início dentro de alguns momentos. Assim sendo, até já. Ora então, boa tarde a todos novamente. Verifica então que já estão aqui a entrar alguns participantes, já estão aqui mesmo no processo de entrada. Sejam novamente bem-vindos a mais uma série do Chicago Trading Sessions. Vamos ter aqui novamente connosco Eric Norland, economista sénior do CME Group, da vulgo Bolsa de Chicago. Iremos dentro de alguns minutos passar-lhe a palavra, falar aqui um bocadinho sobre inflação e os mercados de commodities, a sua relação e, sobretudo, aqui a sua relação com o momento atual. Tal como referido no convite para esta mesma sessão, esta sessão será maioritariamente em inglês e, como tal, eu irei, a partir deste momento, alterar também a minha forma de comunicação, até para que o Eric também nos possa ouvir e participar, e posteriormente irei passar a palavra. Agradeço a todos mais uma vez a vossa presença aqui e qualquer questão estou disponível em português e inglês, caso necessário, através da linha de chat que tem disponível na plataforma. Assim sendo, vamos então dar início. Welcome all to a new series of the Chicago Trading Sessions. We will have with us today, as we have before in the previous year session, Eric Norland, an Executive Director and Senior Economist at CME Group. And today we will bring the subject inflation and commodity markets. It's more complicated than you could imagine. This theme is very, very relevant considering the inflation in the horizon in the US and in Europe too. So we will have this theme discussed. As referred, any question, any doubt that you have, you could all use the chat line available on the platform, and I will be glad to help and seek to answer any questions that you have with the help of Eric Norland, of course. Eric, I don't know if you could hear me at this point.
I can, yes, absolutely.
Perfect. So the ground is yours. Anything that you help, I'm here for you too.
All right, very good. Well, thank you so much for, first of all, for inviting me here to speak with you all, um, and for organizing the entire webinar. This is really a pleasure to be back with you guys to talk about the very important subject of inflation and commodity markets. As I am sure you have experienced in Portugal, just as we have here in the United Kingdom, prices are going higher for all sorts of different goods. Um, and sometimes as an economist, I find myself having a very simple model in my head that, well, higher inflation should be good for commodity prices. If you have higher inflation, that should mean you should expect higher commodity prices. But the truth is, actually, as we will see, much, much more complicated, because there's many different things that interact with inflation and commodity markets, most especially interest rate markets and monetary policy, which can have very complex effects on how inflation actually impacts commodity prices. Before we go into the sort of detail of the presentation, I'm required to show you both the short version as well as a longer and more detailed version of CME Group's disclaimers, which essentially say that we cannot offer you any sort of financial or trading advice. So no advice is given or intended. But let's just begin with inflation. So this is the core inflation rate, excluding food and energy. So basically excluding most commodities for the Euro area, for the United Kingdom, and for the United States. And as you can see, it's gone up to levels that we haven't seen in a very, very long time. It's gone up to levels we haven't seen in the Euro area probably since the early 1990s, before there actually was a Eurozone, before the Euro currency came into existence. And it's gone up to levels in the United Kingdom and the United States that we haven't really seen since the 1980s. In the case of the United States, since the very beginning of the 1980s. So it's been a big inflationary shock. People are obviously very upset about this. We all experience it pretty much no matter what you do, whether it's going to the cinema or buying an airplane ticket or buying a new car or renting an apartment or buying a house or going out to eat, you're seeing the prices are going up, which is obviously not a very pleasant experience. But when we get into the topic of how does this impact commodities, stereotypically the most sensitive commodity to inflation is gold. And so we can talk about the price of gold, and it's a kind of a strange thing, but what you might notice on this graph are two things. First, sometimes you have high rates of inflation and gold prices don't actually move very much, which has been the case during the last, say, couple years. And then sometimes you have low rates of inflation and gold prices might increase tremendously. And so the relationship between gold and inflation is actually very, very complicated. If you start on this chart on the left-hand side of it, going back to the 1960s, inflation was starting to rise at the end of the 1960s, and gold prices actually didn't move for a very simple reason. They weren't allowed to move. In the 1930s, the United States government decided that $1 would be, or I should say rather that 1 ounce of gold would be equal to 35 US dollars. And for decades, the United States maintained this currency pegged to the to gold. They pegged the dollar to gold. But at the end of the 1960s, as inflation began to rise, other people began to take notice of this. And so Americans were not allowed to trade gold. You weren't even allowed to own it except in jewelry. But you were not allowed to own more than like 5 gold coins per person or something like that. But other central banks in other countries did own gold, and they had their own gold reserves, and they could exchange it versus US dollars. So at the end of the 1960s, as the US economy began to overheat as a result of the Vietnam War, spending on the space program, spending on the Great Society, sort of like welfare programs, et cetera, the French president, Charles de Gaulle, decided, okay, you know what? we would like to sell you back your US dollars and then bring gold back into France. And so the French were doing this for a few years until finally President Nixon decided, okay, we can't do this anymore. And he depegged the dollar from gold. And so immediately the price of gold went from $35 to $183 per ounce, which is an enormous percentage move. And it coincided with this huge, huge rise in inflation as the US dollar plunged to around 12% inflation, which was pretty shocking by the standards of the time and would be shocking again if it happened now. And then by the end of the 1970s, gold prices had gotten up to $800 per ounce. And inflation, meanwhile, had gone to 14%. So this kind of gave gold the reputation of being a safe haven in the event of inflation. And then during the 1980s, the United States put interest rates very, very high to get inflation down. It succeeded. Inflation rates fell a great deal. And the price of gold went into a 20-some-year-long bear market, where the price of gold eventually fell from $800 per ounce in 1980 to as low as $280 an ounce by the end of the 1990s and the early 2000s, when Gordon Brown famously sold a lot of Britain's gold to Goldman Sachs at $280 an ounce. But then during the next decade, something really strange happened. You had a gigantic bull market in gold, but there was no consumer price inflation to speak of. I mean, inflation, moved here and there, but in general, it was around 2%. And the price of gold went from $280 an ounce to almost $1,900 an ounce, despite there being not a lot of obvious inflation. But what did happen was that interest rates came down a lot. And we'll talk about the relationship between gold and interest rates in a moment. Now, what's more interesting in recent years is so gold prices first sold off after 2011 for a few years. They hit bottom at around $1,100 per ounce, and then they began to rally in advance of the pandemic. So even before the pandemic began and inflation began to rise, gold prices were already very high. And then once inflation actually did begin to rise, gold prices haven't really gone anywhere. They've been kind of just going sideways. So the question is why? But before we get to the question of why, I just want to show you briefly that it's more or less the same story with silver. Silver, in contrast with gold, traded freely in the United States during the 1940s, 50s, and 60s before the U.S. depegged its currency or delinked its currency from gold. What's interesting here, too, is that silver actually didn't respond very much to the rise in inflation at the end of the 1960s. It responded a little bit, but not very much. But it really responded in a huge way in the end of the 1970s when a pair of traders from Texas, the Hunt brothers, cornered the silver market and drove the price up to $50 an ounce. It then collapsed, stayed low for many, many decades. But then, like gold, and like most metals, actually, it had a huge rally from 2002 until 2011, despite there not really being very much inflation. And then silver prices crashed. And since then, they've gone up, but they actually haven't proved to be a very good inflation hedge either during this most recent period of inflation. And so the question is why? Well, gold and silver may like inflation, but they hate higher interest rates because gold and silver are kind of de facto currencies. They're not official currencies anymore, but as I'm sure you all know, they are historically currencies. But the difference between gold and silver and a currency like the euro or the US dollar is that gold and silver don't pay interest. So when interest rates are at zero and expected to stay at zero, are expected to go down, often gold and silver prices go up, and vice versa. Often when interest rates are expected to rise, gold and silver prices go down. So if you calculate the correlation between the daily change in gold and silver prices with the change in expected Fed funds rates 2 years in the future, you can see that correlation is almost always negative. So almost every time the market expects the Fed will hike rates, gold and silver prices go down. And by contrast, when the market deprices rate hikes or starts pricing rate cuts, or just prices very low interest rates, gold and silver prices often move higher. And so if you look at the price of gold versus our Fed funds futures, you see this relationship play out pretty well. So one of the questions we saw in the earlier chart was, why did gold prices go up so much in 2019 before the pandemic began, and before the inflation began, which really didn't begin until 2021? Well, part of it is that the Federal Reserve was expected to cut interest rates, and in fact later did cut interest rates. So gold was reacting to easier monetary policy. Why was monetary policy easy? It was easy because inflation was low. Now you have the opposite situation. Now the markets are expecting much, much tighter monetary policy in the United States. And so gold and silver are not especially happy with this situation. And why does the market expect the Fed to raise rates? Well, it expects the Fed to raise rates because we have inflation. So basically what seems to happen is that when inflation goes up, that generates expectations of tighter monetary policy, which in turn depresses the price of gold and silver, or at least it can. Part of the reason why gold and silver went up so much during the 1970s is the central bank just lost control of inflation. And for a long time, it didn't seem to want to get control of inflation back. It didn't actually see inflation as being a problem. So it just kept its interest rates too low for a long time. And so gold and silver prices went up for a long, long time. This time is different so far. This time, the market's view is that, well, inflation's a problem, and the central bank knows it's a problem, is going to do something about it. In fact, the central bank, as you know, has already increased interest rates twice, and by all appearances, plans to keep increasing interest rates for at least several more months. But there's an additional catch here. Now, one thing you'll notice here in this chart, in the black line here, or in the previous chart in the left-hand side, where it says in 1 year and 2 years, is the market now is sort of past its peak of expectations for what the Fed can do. So the market for a while had priced, okay, the Fed's going to go above 3%. Now the market's saying, okay, the Fed maybe can't go back about 3%. Maybe we can only get to 275. So why? Well, part of the Fed's problem and the market's problem is now the equity market is crashing. We now have a deep bear market in the NASDAQ 100 and the Russell 2000. The S&P 500 is close to experiencing a technical bear market. So the stock market's falling a great deal. And that's causing the market to say, okay, well, maybe the Fed actually cannot hike interest rates all that far. And the other problem with the whole equity market is that it's just extremely expensive. Here in this chart, in the black line, we have the S&P 500's market capitalization as a percentage of gross domestic product. And you can see that even after its recent correction, it's very, very high. It's still over 140% of GDP, which is higher than it was at the peak in 2000 and much higher than it was in the 1970s or late 1960s before it experienced a very long inflation-adjusted bear market. You can also see with the blue line, however, 10-year Treasury yields, that long-term bond yields, even though they've increased back up to almost 3%, are still very low by historical standards. And so the problem here is that the stock market has a high valuation level because bond yields are still pretty low. And the problem is with inflation, if inflation continues to increase, then long-term bond yields should also increase, which in turn might bring down the value of the stock market. When the stock market goes down, the Fed doesn't like to hike rates because it could create a recession, and that in turn could be good for gold. So what's been happening in gold recently, I think, is interesting. Was in a triangular formation, or what you sometimes would call a flag formation, for most of 2021. And then early this year, it broke out to the upside, and then it corrected back down to the sort of the point of that triangle. And now it's starting to rise again. And so what I think is happening is that gold probably wanted to go higher because of higher inflation, but it couldn't go higher because of this expectation of higher interest rates. But now this expectation of higher interest rates is causing a crash in the stock market. And as the stock market crashes, investors are thinking to themselves, okay, we can't buy bonds because inflation's still too high. We can't buy stocks because bond yields have been rising. So therefore, what's left? Well, what's left is gold. And it might be that gold prices go quite a lot higher. So you can also look at the stock market in gold terms. Like normally we think of the S&P 500 as being priced in US dollars, or at least in index points that are sort of vaguely linked to US dollars. But you could also just say, well, what about if we reprice the stock market in gold? So instead of like saying, okay, what's the exchange rate between the S&P 500 and the US dollar? We say, what's the exchange rate between the S&P 500 and gold? And this is the chart that results from that. So during the 1930s, for example, the price of stocks collapsed and gold prices were stable. Then after the Second World War, for 24 years or so, stocks did very, very well, and the price of gold was just pegged to the dollar, so it couldn't really go anywhere. But then we overheated the economy with Vietnam and the Great Society at the end of the 1960s. And over the next decade, if you had, say, $1 invested in the stock market and $1 invested in gold, by the end of the 1970s, the $1 invested in gold was worth 10 times as much as the $1 invested in stocks. So the stock market did very badly and gold did extremely well. Then things reversed again. So under President Reagan, with Paul Volcker running the Federal Reserve and high interest rates, price of gold crashes, the equity market soared. And so for the next 2 decades, the prices, the stock market outperformed gold by, I don't know, like 2,000%. So in 1980, if you had $1 in gold and $1 in stocks, by 2000, you would have had 20 times as much money invested in the stock market as you would have in gold. But then things reversed again in the first decade of the new century. The stock market fell a great deal versus gold. It fell, I think, by about 70% or more. And then, in the last decade, the stock market has outperformed gold. But now you have to ask yourself, given the stock market's valuation levels, given the level of inflation, given the predicament that the Federal Reserve finds itself in, is this about to turn a corner? And if you look back at the period in the 1970s, you see there was an initial wave down in stocks versus gold. Then it rebounded, the counter trend or false recovery in equities. And then there was a second wave down towards the end of the decade. Well, now we had the first wave down in the stock market, which was from 2000 to 2011. Now we're having maybe another counter trend rally, or maybe it just ended a counter trend rally. And so now one of the questions is, in the 2020s, could gold outperform stocks a great deal because of the inflationary environment and because of the difficulty that the Federal Reserve might have in raising rates if it causes a crash in the stock market? So that's just all something to think about, because gold can be related to a lot of different things, to stocks as well as other metals. Another thing gold really doesn't like is a stronger dollar. So as the Federal Reserve was getting ready to hike rates and starting to hike rates, the US dollar outperformed the Japanese yen, the euro, the British pound, the Chinese renminbi. Basically, all of these currencies fell versus the US dollar. And that is also not good for gold, because gold typically has a negative correlation to the dollar index. So a stronger dollar is not good for gold. But the good news for gold is the dollar may have peaked because the U.S. is no longer the only country hiking rates. Now, Christine Lagarde, the president of the ECB, put the markets on notice earlier this week that the European Central Bank will begin hiking rates in July. So the euro started to recover. As the euro is recovering, gold is starting to recover along with it. So gold also has its own relationship with the currency market, as well as the equity market and the fixed income rate market, which makes its relationship with inflation very, very complicated. All right, so let's move on now to talk about agricultural goods and their relationship with inflation. This is also very complicated, but when you look at the agricultural goods markets, in the 1960s, inflation steadily rose, and agricultural goods didn't really seem to care very much. In 1966, 67, 68, 69, inflation was heading up towards around 6%, and prices of corn didn't really move very much. It was not until 1973 that when inflation started heading to 12%, that the price of corn had this enormous rise. It rose by about 300% in 1 year. But I think it's important to mention why that happened. There were two reasons why it happened. First, the Soviet Union was buying a lot of grain from the United States at the time, and they entered into a deal with the United States government to buy 10 million bushels of wheat. And the US government, for some reason, decided to subsidize their purchase at a time when stocks of corn, wheat, and soybeans were very, very low. Because there had been a really powerful El Nino, followed by a La Nina, so the US agricultural market was all kind of messed up. The Soviets bought a huge amount of grain, what was known as the Great Grain Robbery, and that sent prices higher. Secondly, you also had the Arab oil embargo. We'll talk about why that was important in a few minutes, but corn and oil prices are very closely related, as we'll see. And then what happened in the rest of the 70s is also interesting. Is inflation came back down around 1976, but then in the second half, in the later years of the 1970s, inflation surged to over 14% in the US. But what's interesting here is that agricultural goods prices went up, but they didn't really go beyond their previous highs. And what happened is ag prices just stayed in a range that would last for the next 35 years. So between 1973 and 2006, basically a third of a century, prices just stayed in a range, even as inflation first went higher and then came a great deal lower. Then during the first decade of the new century, we had this huge rise in agricultural goods prices again, but there was no obvious connection to inflation. What happened there is China's growth became very high, and we had a huge run up in metals prices and energy prices that eventually, as we'll see, influenced the price of agricultural goods. So it's really only been during the last 12 months or so that inflation and agricultural goods have started moving in the same direction. We've seen a huge rise in corn prices from 300 cents per bushel or $3 per bushel to over $8 per bushel. This is obviously an enormous move, and it coincided with inflation in a way that we haven't seen really since 1973. And we'll talk about why that is in a minute. And so you see more or less the same relationship with soybeans. Inflation rose in the 60s. Soybean prices didn't care much initially. But then suddenly in 1973, the ag markets discovered that inflation had gone higher, and they had a huge reaction. But then soybean prices, like corn prices, didn't go anywhere for a third of a century. So from 1973 to 2006, they basically did nothing. And then they had this huge rise, even though inflation stayed low. So it's only been in the last 12 months that we started to see inflation and soybean prices move in the same direction. And of course, it's the same story for wheat. So I'm not going to repeat it again. You kind of understand the story now. Wheat didn't care in the 60s that inflation was going higher. It suddenly cared in 1973. It entered into a range that lasted a third of a century. Then wheat prices rose again, even though inflation did not. And it's only been in the last 12 months that inflation and wheat prices have started to rise together. The message of this, I think, is very simple for investors. It's a don't think that you can hedge yourself for inflation with corn, wheat, or soy, or even gold or silver, because they do different things. Yes, sometimes higher inflation may be accompanied by higher agricultural goods prices, but it's not a guarantee. So these markets cannot really be used to hedge consumer price inflation. So what do they relate to? So the relationship between inflation and corn, inflation and soybeans, and inflation and wheat is not especially strong. But what is very strong is the relationship between oil prices and these various agricultural goods. So corn, it doesn't really care about like the cost of housing or the cost of buying services or the cost of airline tickets and all the other things that go into measuring inflation. But what it does care about is a very specific thing, which is how much does crude oil cost? And there's two reasons why this is the case. First, agriculture is a very energy-intensive business. In order to grow corn or wheat or soybeans or any other kind of agricultural good, it requires a lot of fossil fuel energy. So basically, you have to plow the fields, you have to plant them. That requires machines that use diesel fuel or gasoline. Then you eventually have to harvest the crop, and then you have to take the crop and send it to market and to delivery points. And so if oil prices go higher, that increases the input cost for producing corn or wheat or any other kind of agricultural good. In addition to that, there are other things that can cause wheat and corn to relate. So for example, pesticides are primarily derived from crude oil. Also, how do you say it? Fertilizers are made from natural gas, which is a different but related, fossil fuel, as well as potash. And so potash, which is basically potassium oxide and other things, potassium nitrates, has to be mined, and mining it is also very energy intensive. So the whole process of creating fertilizer involves a great deal of energy. The same relationship holds for vegetable oils like soybean oil or Bursa Malaysia's palm oil, all of which also show a very strong degree of relationship with oil prices. What I think is interesting here, maybe the most interesting thing here, is that sometimes these vegetable oils are actually a leading indicator of crude oil. You have to look at the charts very carefully. If you look at the left-hand chart, you can see that soybean oil prices hit their highest level 6 months before crude oil prices did in 2008. In early 2009, they hit bottom before crude oil. In 2011, they hit their peak before crude oil, and they began to sell off in anticipation of the crash in crude oil prices in 2014 and 2015. Then you had, they hit bottom before crude oil did in 2016 and 2017. So now I think the disconcerting thing is soybean oil prices have not really necessarily reached their peak yet, which may indicate that we have much, much higher prices ahead on crude oil. And so the other thing about the agricultural goods markets and oil is that not only is oil part of their input cost, but the agricultural goods are also used in final fuel blends because of biofuel mandates. So for example, in the United States, it's a requirement that corn be converted into ethanol and that the ethanol be blended into gasoline for cars, for example. And there are 65 countries around the world, including the countries of the European Union, Brazil, the United States, and China, that require the use of biofuels as part of the production of gasoline and diesel and other plastics and other crude oil derivatives. So basically what happens is that when the price of oil is going higher, the oil companies, the refining companies, will call up the farmers and say, hey, we need more soybean oil, or we need more palm oil, or more ethanol from corn or sugar to mix into our final fuel blends. So it's always, of course, a relevant question to say, well, what's happening in the crude oil market? Well, crude oil prices that we've seen have gone a great deal higher. They may still go higher even now. If you look at the production side, OPEC has refused to increase its production. Russia is not really in a position to increase its production because it's basically been cut off from financing from the global economy. And Europe, of course, is looking for ways to stop buying Russian oil. And if you look at the inventory levels in the United States, inventories of crude oil for 2022, which you see here in the light blue line in the left-hand part of the right-hand chart, crude oil inventories are very, very low. And so oil production in the US has been rising, but it hasn't even gotten back to its peak in 2019. So inventories are extremely low. So the market is really tight. People are traveling again. People are buying, oil. They're driving, they're flying, etc. But the oil inventories are very low. And it's even a worse picture when you look at gasoline or diesel. Gasoline inventories here you see in the light blue for 2022 are very, very low compared to where they were at the start of the driving season, the summer vacation season in the previous several years. And it's even a worse picture for what we call ULSD, ultra low sulfur diesel, which is basically diesel fuel or heating oil. Those inventories are also at extremely low levels. So we have a shortage of oil. Oil prices are going higher, and that's driving the price of agricultural goods higher. So what agricultural goods I think are really responding to is a shortage of oil. And so that's the other thing about why did corn prices and wheat prices and soybean prices go up so much in 1973? It was because of the Arab oil embargo. After the Arab-Israeli war in 1973, the Arab countries decided to reduce their production of oil and to cut their exports of oil to Europe as sort of a punishment for supporting Israel in the war. And so the price of oil went from $3 to $14 per barrel, and it sent the prices of agricultural goods up to 300%. At the same time as the Soviets were also doing this huge purchase of wheat in 1973. So if you're wondering why it is that agricultural prices have risen so much, part of the reason is because oil prices have rebounded, and oil prices may go higher still because of the very low levels of inventory and the refusal to increase production. But what we have not talked about yet is copper and other industrial metals. Copper is also very closely related to oil. I spoke at a copper conference recently in Chicago about 2 weeks ago. And in the copper conference, they showed this fascinating video about how copper is produced. And every stage of copper's production is massively energy intensive. First, and when they strip mine it, they first drill holes down about 20 meters in the ground, and they fill those holes with explosives and blow them up, which creates these huge rocks that are about the size of automobiles. Then they take these gigantic trucks that are maybe like 4 stories high, like the height of a 4th floor of a building, and they take these rocks and then they put them into a machine that crushes them and makes them into rocks that are about the size of a rugby ball. Then they put those into another machine that crushes them into sand. Then they keep breaking it down until finally they heat it up and they skim off copper from the top, etc. And the whole process is just massively, massively energy intensive. And they have to get the copper to 99.99% pure in order to be able to use it. And every stage of this process involves the use of fossil fuel energy. So when fossil fuel prices like oil prices go up, the price of copper has to go up. It has no choice. And so part of the reason why copper prices have gone up is simply because energy prices have gone up too. But copper also has its own sort of special relationship with monetary policy that I think gold and silver also have. Not only did the Federal Reserve print a lot or lower interest rates to zero, but they also printed a lot of money, as did the European Central Bank, the Bank of Japan, et cetera. And when you look at the Fed's balance sheet versus other assets, you can see that when the Fed expanded its balance sheet, technology stocks like the NASDAQ 100 went way up, and copper prices also went way up. And now the Federal Reserve is getting ready to shrink its balance sheet. It's going to begin balance sheet reduction starting in a few days on the 1st of June, which I think is 1 week from today. The Federal Reserve will begin shrinking its portfolio of bonds. So the stock market is already selling off in anticipation of them pulling liquidity out of markets. And so, the stock market had this sort of conclusion when the Fed was expanding its balance sheet that it was always the right thing to buy on dips. Now that the Fed's going to be shrinking its balance sheet, the market's saying, okay, buy on dips no longer work. Instead, you should do the opposite. You should sell into strength. And so copper also has its own relationship to other sectors of the economy. Let me skip one slide. Copper has a positive correlation to the S&P 500 and the NASDAQ. So the fact that the equity market is selling off is not good news for copper. But copper also has its own relationship with the interest rate market as well. One of the shocking numbers that we had earlier this week was new home sales in the US, which completely collapsed. Why did they collapse? They collapsed because mortgage rates went higher. Why did mortgage rates go higher? They went higher because US Treasury yields went higher. Why did they go higher? They went higher because inflation went higher. So you can see that higher inflation is not necessarily good for copper, because as inflation increases, people will buy fewer new homes. And every home in America has, on average, about 200 kilograms of copper in it. Automobiles also have a great deal of copper in them. The copper is in the wiring of almost every product. So when they build new homes in Portugal or Spain or any other country, it involves a tremendous amount of copper. When interest rates increase, people can't afford to buy as many new homes, so that negatively impacts copper. So in a sense, higher inflation is not necessarily a good thing for copper. So I thought we would conclude just by looking at two other things. So first of all, what's going to happen with inflation in the future? And secondly, what's happening in China, which is the other really big mover of commodity prices. I think a bigger mover than inflation. And China has its own inflation story that's very different than ours. So first of all, markets do not expect that inflation is going to stay high. The market believes inflation will stay high in 2022, but then inflation rates, will come down significantly in 2023 and basically go back to just 2% per year by 2025. And so why does the market believe that? Well, the market believes that because it thinks, I think most investors believe, that the inflation was just temporary. It was temporary because during the COVID lockdowns, we couldn't spend money on services, so we all shifted our spending to goods. So spending on goods rose over 20% in the 2 years from 2019 to 2021, and that outstripped the ability of the economy around the world to produce manufactured goods. So manufactured goods prices rose like 18% or so over the last 2 years. But now everything's reopening, so the market seems to think everything's going to go back to normal. Another reason why inflation happened is because the U.S. government in particular spent a huge amount of money. So government spending in the U.S. went from 21% to 35% of GDP. As that happened, it created a lot of demand, but it didn't create any new supply. So of course, as everybody knows from economics in university or even high school, when you increase demand but you don't increase supply, you wind up with higher prices. But the good news, though, is government spending is now coming back down very quickly because all of these pandemic programs to support the economy during the lockdowns are now expiring, and it's all going away. And so the market believes, okay, well, the government spending goes away, inflation also goes away along with it. If you look at the size of, we saw earlier that Eurozone and core inflation is not as bad as it is in the US. It's because the Eurozone didn't spend as much money. Countries like Portugal and Spain and France and Germany and Italy did spend money during the pandemic, but they didn't spend as much as the United States. So Europe, therefore, doesn't have to raise interest rates as much as the US, and it doesn't have as much inflation. And you really see that when you compare the consumer spending numbers. The consumer spending number for the US is in dark blue. You can see it was on a nice steady uptrend before the pandemic. And then with all of the US government spending, it went way above its previous trend. But I guess the good news for inflation is now consumer spending adjusted for inflation is not really changing. So consumer spending is still rising in dollar terms, but the prices have risen. So the volume of goods that Americans are able to buy is actually not increasing. And what that means for copper and aluminum and all of the other industrial metals is that consumers are actually not consuming more of those metals now than they were a year ago. So hence you see copper prices moving sideways during the last 12 months and then taking a really sharp drop over the last, say, 4 weeks or so before they recovered slightly. And the US economy is still a mess. We may still have higher inflation ahead because we're now only about 1.2 million jobs below peak employment. Employers are still looking for 11 million people to hire. But as the stock market crashes, credit spreads are widening. As credit spreads widening, companies will hire less. They may start to lay off workers. So the market thinks, okay, well, the stock market's going to crash or is in the process of crashing. So therefore, that's also going to bring down inflation. So the market obviously believes the Fed's going to hike rates more than the euro area. But let's talk about China. So China spent very little money supporting its economy during COVID, and Japan didn't spend much either. So in Japan and China and even in Korea, inflation rates are not very high. And the other thing that really influences commodities is China and its growth rate, much more important than inflation. And so in China, they have two measures of they have a lot of measures of the economy, but the two I like are the official GDP number and this other measure called the Li Ka-shing Index. And the Li Ka-shing Index is composed of only three things. It has bank loans, electricity production, and rail freight volumes. They're all things that the Chinese government can't easily lie about. And so when you look at the Li Ka-shing Index, it has a really high correlation with what happens with aluminum, copper, wheat, soy oil, corn, and crude oil prices in 12 months' time. So let's look at these charts. When you compare the Li Ka-shing Index, which is in a light blue dotted line with copper, you can see that when China's economy accelerates, copper prices react later and rise. When China's economy goes down, copper prices react later and fall. And China's economy, as I'm sure you've all seen, is in a really, really bad shape right now. Not only do they have COVID lockdowns, they have tons of other problems. But the important thing here on the right-hand chart is that the relationship between copper and the Li Ka-shing Index normally has a 4-quarter lag. So what happens in China today for the Li Ka-shing Index impacts copper 12 months later. So you have a long time to potentially adjust portfolios to changes in Chinese growth. So you may be wondering, well, if China's economy is doing so badly, why is copper still so high? Well, give it 12 months. The price might be a lot lower. Same thing if you look at oil prices. Oil prices have a really strong relationship with growth in China. China had very strong growth in 2021. We're seeing high oil prices now in 2022. But China's growth rate's falling now a great deal. And so we might wind up with lower oil prices at some point in 2023. We'll have to see, I don't know. But the same relationship between corn prices and Chinese growth, although the lag is a little bit longer. It's more like 5 or 6 quarters. So instead of a 12-month lag, it's more like an 18-month lag. Why is that? Well, because China's economy first influences oil prices, and then through oil prices, then influences corn, wheat, and soy prices. They see the same relationship between China's economy and agricultural goods like corn, wheat, and soybean oil. So what's happening in China? Well, very briefly, nothing good. Everything that's going on in China is pretty bad right now. Their currency has started to fall like a rock since April 21. It's actually bounced up a little bit this week. But China is easing monetary policy. It's actually reducing interest rates. It's reducing its reserve requirement ratio. Why? Because China does not have inflation. China's inflation rate is very, very low. So you have high inflation in the US, which is having one set of impacts on commodities. You have low inflation on China, which is allowing the central bank to do the opposite and to weaken its currency. So why is the central bank cutting rates? Well, part of it's because of the COVID lockdowns. But part of it's because China has extremely high levels of debt. Back in 2009, when China eased monetary policy to get its economy to recover, they had a huge, huge surge in economic growth. And that huge surge caused a gigantic recovery in the prices of energy, agricultural goods, and industrial metals. But they can't do that a second time because look at their debt levels. Their debt levels are no longer really low like they were in 2008. Now they're extremely high. They're even worse than the Eurozone and the United Kingdom in terms of debt. And so what else is happening in China? Well, China has a gigantic real estate bubble. I know this is a Portuguese audience, but I'm sure you remember Spain's real estate bubble from 2006. If you look at China's economy, a larger percentage of it is oriented towards real estate now than was the case in Spain in 2006. And so China's real estate market has begun to go down. We've seen this with the collapse of very large firms like Evergrande and so a lot of these firms are starting to collapse. And China also has a junk bond market, or a high yield bond market, to use a kinder expression. China's high yield bond market is crashing. It's down 40% from May last year. And so they have too much debt, and the cost of financing the debt is starting to soar. And that's putting a lot of downward pressure on China's economy, which will translate eventually into lower demand for commodity prices. So as you can see, the relationship between inflation and commodities is extremely complicated because you have to decide whose inflation are we talking about, the US or China, and what's going to be the reaction of monetary authorities and fiscal authorities to that inflation, and how will that impact commodities. So it's a very complex story that's kind of always moving. So that's the presentation. We have, I think, quite a lot of time for questions, or at least I do. So are there any questions?
Yes, we have some questions on the chat line here. Thank you for your presentation. It was really, really clear. I think we will go back for some points. I was recollecting here some questions during the presentation. And let's go back to crude oil and the OPEC decision to not increase the production at this point. Could you go back to this subject and try to understand if there is a shortage on crude oil at this point, why OPEC does not open the production for a little while and ease the prices?
Yes, I think for OPEC, it's a really simple story. They suffered a great deal in 2014, 15, and 16 when oil prices crashed. And then oil prices were just starting to get back to normal in the late 20-teens in 2017, 18, and 19 when the pandemic struck. And then we even had negative prices in the US briefly, and the price of Brent crashed down to, I can't remember, like $10 or $20 a barrel. So countries like Saudi Arabia and the United Arab Emirates and Iran and Iraq and Venezuela, they all lost a lot of revenue. So they see this as an opportunity to make the revenue back. They're basically saying, okay, well, if oil prices go to extreme lows, we lose revenue, maybe they'll go to extreme highs and we'll make that revenue back. And they're not the only ones who feel this way. In the US, you have the frackers. And the frackers are putting back production, but very, very slowly. And if you talk to the oil companies in the US, what they'll tell you is they say, hey, we lost a lot of money too when oil prices crashed in 2020 at the beginning of the pandemic. And yeah, we would rather use the period of high prices to reduce our debt levels so we don't get into financial trouble the next time oil prices crash. And we also want to pay our shareholders, to pay them dividends, to do share buybacks so that they get paid as well. And then lastly, there's, I think, political reasons too. I think that Joe Biden really offended the Saudi leadership. I mean, Saudi Arabia, as you know, has sort of two leaders, if you will. It has the official king, but it also has MBS, the crown prince. And Joe Biden, at the beginning of the administration, basically said, you know what, I'm not doing any business with MBS because he killed Khashoggi, that journalist who, got hacked apart in Istanbul, at the Saudi consulate. It's truly an ugly story, but whatever. So Joe Biden doesn't like MBS on humanitarian grounds. He only wanted to deal with King Abdullah. But the problem is the king is sort of like out of it. He has no idea what's going on. And so MBS is just offended. MBS has control of Saudi Arabia pretty much. And he's like, okay, you know what? I'm not going to cooperate with you people. I'm not going to get you out of this problem of high oil prices. And likewise, Joe Biden also offended the leadership of the United Arab Emirates, another big oil producer. So none of the countries in OPEC really want to do any kind of business with him, really want to bail him out of his political problems because of high oil prices.
Okay, thank you. Even in this subject, also we have the question about the following: since the price is not decreasing because OPEC doesn't increase the production, it could be, or we could feel a poor demand on such prices, or if the prices increase to levels upside than this. So would this make OPEC go a step back on this decision, or you think, on your view, that at this time OPEC will not increase the production and take some profits considering the damages in the pandemic at the time last year?
Yeah, I think that, so. I don't think OPEC will increase production quickly. OPEC typically has two big meetings per year, usually in May and in November or early December. So I think they will have to wait until maybe the end of the year, until November or early December, to see if they revisit their decision. But I mean, it's always possible, but I don't really see why they would revisit their decision right now. OPEC is probably a little worried about destroying demand. If oil prices go up too high, it can cause people to start cutting back consumption a great deal, which isn't really in their interest. But yeah, I think that they're probably unlikely to revisit their decision for at least 5 or 6 months.
Okay, thank you. Another question now for a different subject. There is actually a big spotlight at energy transition. Do you or any idea what is the correlation between oil and lithium, like you did before on the copper subject?
Yeah, so I should have highlighted. I actually have some slides. When I send out the final deck to you that you can distribute afterwards, I will put in some lithium and cobalt slides, as well as some natural gas. I think lithium and cobalt are most strongly connected to natural gas because ultimately lithium and cobalt are used to create batteries, and batteries sort of help to solve the problem of alternative energies like wind and solar that are intermittent in nature. Solar panels only produce when the sun's shining, wind turbines only produce when the wind is blowing. And so essentially they compete mainly with natural gas in the electrical generation, and in the case of lithium and cobalt, electrical storage. So natural gas prices have increased a tremendous amount worldwide. They've gone up about 200% in the US and about 700% across Europe and Asia. And that's been the main factor in increasing lithium and cobalt prices. But oil prices also have the same relationship with lithium cobalt as they would have with copper, for example, in a sense that metals mining in general, including for lithium and cobalt and other metals, is extremely energy intensive. And so higher oil prices almost necessarily imply a higher cost of production for those metals.
Okay, thank you. Another subject, we have, I think, more 2 questions pending. You referred previously the relation between China and agricultural goods and the time that takes to this correlation to happen. So we are being asked if we could expect for the next few months, not the next ones, but for next quarters, to a pressure on agricultural goods. Considering the problems that we are facing now on Ukraine soil. So, could this take that effect, considering the pressure on demand?
Yeah, so I think that the Russia-Ukraine war is having obviously a tremendous impact on agricultural prices in the short term, and maybe over the intermediate term, because the war, as I'm sure you know, doesn't show any signs of ending quickly. But I do think that other countries are going to find ways to work around the war to help the Ukrainians to get their crops to market. At the moment, there's about a 75-kilometer long line of trucks trying to get the wheat and sunflower oil and other products, corn, out of Ukraine and into the European Union so that it can then be exported from Romania through the Black Sea. And this is creating a huge logistical nightmare. I was at a conference this weekend, an agricultural conference in Istanbul, where they were talking about this, and I met somebody who was involved with the first shipment of Ukrainian products out of Romania. He said there was 4,000 pages of paperwork to get the products into the EU and then to re-export them. So I think what's happening now is the Ukrainians and the Europeans are discussing how to streamline this process to make it much easier for Ukraine to export its goods through Europe to the rest of the world. And I think that they will find a solution, because obviously you can't continue with this. If you do continue with this, you'll wind up with starvation in Egypt and many other countries that rely a great deal on wheat coming out of the Black Sea. Also, more recently, you've talked about the possibility of NATO escorts for Ukrainian ships from Odessa coming out to the rest of the world to sort of block the Russian Navy from attacking them. That would be a bit more militarily aggressive, but if that happens, it could put downward pressure on goods, on ags prices, as it would allow these things to reach market more easily. With respect to China, I do think China's economy is slowing a great deal. I think that China's economy is in very, very bad shape, worse shape than people realize. And I think that they will show a lot of slowdown. I don't think that will have any immediate impact on ags prices. I don't think it will have any impact over the summer, maybe not even over the fall. But as we get into 2023, especially maybe towards the second half of 2023, it could have a very strong negative impact on commodity prices, including agricultural goods prices. And of course, it will also depend on what state Ukraine is in and what state Russia is in and what's happening to many other things that influence ags prices, including the droughts in North and South America and other problems.
Okay. Thank you, Eric. The last question that we have is not really a question, but if we could share the presentation after the webinar, I don't see a problem in our side, and don't know if you have one in this. So if you don't,
we can definitely share it. Yeah, we can definitely share it, and I'll add in a couple of slides. I'll add in a couple of slides on natural gas and on lithium and cobalt, so you can just sort of see those as well.
Okay. It was the last question. I have to thank you once again, Eric, for accepting our invitation to revisit the Chicago trading sessions. We will have another session with you in June for another subject. So thank you once again for your presence, for your availability, and for your availability for our questions on this matter.
Thank you very much.
Okay. Thank you all to be here with us. Any questions that you have, please tell us on the chat line or in the other communication that we have with us. Any questions, any doubts, please be our guest, and we will send the presentation afterwards in a few days with the blessing of Eric. Thank you all for being with us, and have a great day. Thank you, Eric. See you next time.
Thank you very much. Cheers. Bye.
Bye.